Okay, let's dive into this. Welcome to today's explainer. Over the next 10 minutes or so, we are going to completely unpack the vital role of AISC, that's all-in sustaining cost in the mining sector. Now, if you've been watching the precious metals market recently, you know the spot prices are moving incredibly fast. But to understand the true wealth being generated, we have to look far beyond the daily ticker. We really need to look at the ripple effect. We're talking about how a single ounce of gold literally transforms economies from the ground up.
Here is the roadmap for our journey today. 1. The power of AISC. 2. Decoding the AISC metric. 3. Efficiency drives record profits. 4. Fueling local economies. 5. Planning post-mining land use. And finally, 6. Strategies for 2026 mining. I want to start by hitting you right out of the gate with this staggering number, $2,800. With gold trading near $4,700 an ounce, the industry is seeing average all-in sustaining costs settling around $1,600 to $1,800. That leaves top-tier producers generating an operating margin of roughly $2,800 per ounce. This is absolutely historic. It's the widest spread in gold mining history. To put that into perspective for you, top-tier producers are generating cash at rates and margins that honestly make some top Silicon Valley tech stocks look pretty expensive by comparison. It is a cash generation engine unlike anything we've seen in recent decades.
Section 1. The power of AISC, beyond the balance sheet. You see, the primary thesis for investing in mining equities over just holding the physical metal is all about the exploitation of operating leverage. A mining operation has relatively stable fixed costs, right? You've got your debt service, administrative overhead, baseline plant power. Because those baseline costs stay flat, any rise in the realized price of the metal flows directly to the bottom line, which expands operating margins exponentially. Think of it like owning a bakery, where your rent and your ingredients cost exactly the same month to month, but suddenly people are willing to pay triple for a loaf of bread. Your profit doesn't just go up incrementally, it multiplies. That is exactly why mining stocks historically offer 2 to 3 times the leveraged return relative to spot prices.
Moving right along to Section 2, decoding the AISC metric more than just cash costs. And this brilliantly illustrates why all-in sustaining cost, or AISC, is our skeleton key concept for today. It was introduced by the World Gold Council specifically because the industry desperately needed transparency. You see, the old metric of simple cash costs was essentially hiding the true, heavy financial burden of running a mine. AISC captures every single dollar required to keep a mine producing at its current level. We aren't just talking about digging rocks out of the ground here. AISC includes corporate general and administrative expenses, near-mine exploration to replace reserves, sustaining capital for heavy equipment, and crucially, absolutely crucially, long-term environmental reclamation and closure provisions. If we break down the estimated components and look at the trend comparisons projected out to 2026, you're going to notice that the total global average AISC is climbing. But look specifically at where that growth is happening. It's the sustaining capital and the environmental costs that are rising the fastest, jumping from $85 up to an estimated $100 per ounce by 2026. This is being driven by stricter governmental mandates, labor scarcity, and aging infrastructure. These compliance and upkeep costs are placing immense pressure on operators. What this proves is that a consistently low AISC isn't just a happy accident. It is the direct result of highly disciplined, forward-looking management. Which leads us to Section 3, efficiency drives record profits, amplifying the margins.
Because those input costs are rising, companies are aggressively fighting back through operational efficiency. And the math behind this leverage is just incredible for those who are positioned correctly. Imagine a producer has an AISC of $1,500 per ounce. If gold prices rise from $2,500 to $5,000, the metal price only doubled, right? But the company's profit margin leaps from $1,000 to $3,500 per ounce. That is a massive 250% increase. It's a huge divergence in growth metrics compared to broader equity markets. It shows exactly how a lower AISC creates incredible resilience against price drops and explosive leverage during a bull run.
But we have to remember, these efficiencies and massive revenues don't exist in a vacuum. Let's look at Mexico as an example, where a side-economic study modeled the macroeconomic impact of the sector. They found that a 60% reduction in mining activity, which is the scale associated with potential open pit bans, would trigger a 0.86% contraction in national GDP. That is roughly 359 billion pesos completely wiped out of the economy. It's not just a localized issue either.
mining directly influences 192 different branches of the national economy, touching everything from transportation and logistics to heavy manufacturing. The cost of an action or contraction here is literally staggering.
So the crucial point is this. When a company optimizes its AISC, the benefits multiply across the entire system. Just a 10% improvement in technical efficiency across the mining chain could yield 14.1 billion pesos in additional tax revenue. For governments, maximizing mining efficiency isn't just a corporate win, it's a powerful fiscal mechanism. Think about it. Those are the funds that directly pay for public administration, build local schools, pave community roads, and support vital social welfare programs.
Which naturally leads us to ask a really important question. Where do these massive margins and tax revenues actually go when we look past the corporate spreadsheets and focus on the ground level? Welcome to Section 4, Fueling Local Economies, the ripple effect in action. If you track major indices, like the TSX 30 on the Toronto Stock Exchange, you see Tier 1 producers generating cash flows that easily rival massive tech companies. But unlike a software company, a mining operation is a very physical, structural anchor for regional economies. Global capital is increasingly rotating into stable jurisdictions exactly because this wealth generates real, long-term economic resilience. To really contextualize this, let's look at the ground-level data. In Mexico alone, the sector supports over 416,000 formal jobs, and the average wages are coming in at 3 times the national minimum. 3 times! That represents true generational mobility for a family. Furthermore, recent legal reforms require that at least 5% of mining profits be paid directly back to affected indigenous or local communities. This isn't just corporate charity. It is structured wealth distribution codified into law, deeply linking a mine's profitability to the long-term prosperity of its host region. We can see a prime example of this in practice with Avino silver and gold mines. Established operations like theirs contribute meaningfully through local employment and training, sourcing materials locally, and building shared community infrastructure. Prioritizing these community relationships is absolutely essential. It secures their social license to operate and actively reduces the risk of illegal mining in the area, creating a much safer, more prosperous environment for everyone involved.
Let's move to and see how this builds in Section 5, Planning Post-Mining Land Use, a Promise to the Land.
Because the truth is, a mine doesn't last forever, and a properly calculated AISC prepares for the exact day the ore runs out. A strict AISC metric forces companies to budget for environmental closure and land rehabilitation on day one. By knowing exactly when a mine will reach its end of life, companies can coordinate a seamless handover. All that heavy infrastructure built during the mining phase, we're talking heavy-duty paved roads, upgraded power grids, and advanced water treatment facilities, it doesn't just get abandoned. Instead, it gets transitioned into incredibly valuable resources for the local agrarian community, turning a former industrial site into fertile, heavily supported farmland. To understand how this works, we can look at Mexico's rural landscape, much of which operates as ejido land. Now, ejido is a unique system of communal property used primarily for agriculture, and it's governed by the community itself. Mining concessions require explicit, respectful land use agreements with these ejido communities. By sharing clear, AISC-driven closure schedules, local farmers and forestry managers can actually plan out their long-term supply chains. They know exactly when rehabilitated land and world-class infrastructure will be returned to them for agricultural use. It's an incredibly smart cross-sector partnership built directly into the mining lifecycle.
Which brings us to our final stop, Section 6, Strategies for 2026 Mining, Securing the Future.
Companies have to adopt a modern playbook to stay competitive while facing these rising compliance costs we've been talking about. The 5 high-impact strategies include, first, heavily leveraging new technology for exploration. Second, aligning sustaining capital directly to long-term efficiency upgrades rather than just slapping on quick fixes. Third, proactively budgeting for strict ESG requirements so there are zero surprises down the road. Fourth, collaborating across sectors, just like we saw with agriculture. And fifth, maintaining totally transparent AISC reporting to build undeniable trust with investors and local communities alike. One of the most fascinating technological shifts hitting the industry is happening right now in exploration. To keep that sustaining exploration component of AISC low, operators are turning to tools like Farmanaut's AI-driven satellite mapping. This is a real game changer. Instead of sending fleets of trucks and drills out to blindly test the ground, AI screens massive areas for mineral prospectivity from space using multispectral analysis. companies can reduce early-stage exploration costs by an astounding 80 to 85%. And they do it with absolutely zero early-stage land disturbance. It is the perfect alignment of extreme cost-cutting with stringent environmental compliance.
Now, what's really interesting about this slide is the broader implication for the future. The demand for metals, driven by global nearshoring and a massive energy transition, is only accelerating. We've seen today how tracking AISC isn't just some boring accounting practice, it's the actual heartbeat of a sector that funds governments, uplifts local communities, and totally transforms infrastructure. The ultimate question we have to ask is, will operators continue to embrace these technological and social efficiencies to unlock mining's full potential? Because if they do, the ripple effect will be profoundly positive for decades to come. Thank you so much for joining me on this explainer today, and as always, keep learning.